Good evening, everybody. Thanks for joining us again. This week, I want to take a look at slow stochastics, which is a momentum-based indicator and very useful within the suite of technical indicators that are available. And basically look at what its restrictions are, but also how we can use it to time trades and highlight when we can actually execute positioning within ongoing trending conditions. So let's take a look at the indicator and just sort of see the types of techniques that we can use with the slow stochastic. Now, it's a momentum-based indicator that offers turning points within market activity, and it allows us to gauge when the market is getting overextended or indeed just resuming an ongoing trend. And basically, people will use it as an overbought, oversold indicator. So if we're above, say, 70%, people will class the market as being overbought. If we're below 30%, then it's classed as being oversold. Now, that's all well and good, but we need to be aware that the slow stochastic and any momentum-based indicator is not that reliable within a trending market, be it to the up or to the downside. However, when we see a sideways trading range form, that's when the overbought and oversold readings come into their own and reflect turning points within the market. Now, a stochastic indicator basically takes the current level within a certain range period. Now, the default setting for that is a 14-day period with a smoothing factor of 3. Although I've actually sort of tweaked that slightly, and I've shortened the period to 10 periods. So basically, it's taking the latest level within the range of the last 10 periods. As prices rise, then the market tends to close towards the upper limits of that period's range. So as we start to see stochastics turning up, it reflects that the current level within the range of the last 10 days is increasing. As we start to see corrections develop, then the current level within the range of the last 10 periods declines. And that's when we see stochastics turn lower and highlight the market is seeing momentum turn down and the risk of further weakness. So the input that I actually have adjusted the slow stochastic to, when you look at your trading system, is 10, 3, and 3. So it's a 10 period with 3 period smoothing factor. But I find that just gives me slightly better signals and slightly earlier signals. Now, traditionally, the indicator is used, as I say, as an overbought, oversold. So if we start to see upside momentum slowing and turning down while the indicator is above 70%, then people will highlight that as an overbought reading, momentum turning down, and the risk of a more extended sell-off. In the same way, downside momentum starting to slow, and we see the indicator crossing higher, then from below 30% reflects an oversold condition and the potential of momentum moving up and prices extending the recovery for a more prolonged period of time. Now, the problem is that these overbought and oversold readings within an aggressive trending condition will often be ignored by the market as a whole. So in other words, if we're seeing an aggressive uptrending or a strong upside move in price, the overbought reading will be ignored, and we need to be aware that we should not take notice of overbought conditions within that sort of setup, because the risk is that the market will continue to move within the direction of the trend for a much more prolonged period of time and highlight the risk of further acceleration of that ongoing trending condition. So we need to be aware of the trending condition within the market. Now, as I say, slow stochastics and momentum-based indicators in general are very good within a sideways trading range. So if we look at the daily chart of gold, dating back to April a couple of years ago, we saw that the market is trading within a clear sideways trading range. Resistance being found at upper limits, and support being and buying support developing at lower limits. And if we run the slow stochastic using the parameters that we've already highlighted, we can see that overbought conditions where the indicator turns down above 70%, a traditional overbought level, and then momentum turning lower, we can see reflects turning points within price activity from overbought levels to see corrections developing. Equally, when the indicator starts to turn up, these first two signals are not from traditional oversold readings, but we can see the last two signals developing from when the indicator was below 30%. But we can highlight the fact that momentum turning up when the market is within a sideways trading range reflects a very strong overbought or oversold reading and the risk of a continuation of that sideways trading area and a reaction to the direction of the recent move. So within a sideways trading range, the slow stochastic from an overbought level turning down can give us strong signals for a market correction, while momentum becomes oversold and turns higher is a strong signal that the market is likely to find support and rally and extend the ongoing sideways trading range. However, when we look again at the gold on a daily basis for a slightly prolonged period of time, we can see that the sideways range that we were just looking at is evident within this period here. So this sideways activity is when we were starting to see more balanced activity developing, and those overbought and oversold readings within the indicator worked relatively well. However, as soon as we start to see an upside break from this range and more aggressive trending signals begin to emerge, so the market is rallying very strongly and accelerating within this bullish trend, it's not so much the overbought levels that we need to be aware of, because we can see that every time the market or the slow stochastic is above its 70% level on a consistent basis. And each time the indicator crosses below its own moving average to reflect an overbought reading, the correction is limited before the market resumes this ongoing positive trend. So we can surmise that overbought levels within a positive trending condition are ignored by the market, and that we continue to see prices accelerating higher within that environment. So it's not so much the overbought levels within a confirmed trend, within an uptrend, that we want to be aware of. It's more when momentum turns higher within this aggressive bullish trend that actually gives fresh buy signals. So it's not overbought or oversold conditions that are important within this type of trending condition. It's more within a bullish trend when the indicator crosses higher, no matter whether it's at a traditional overbought, oversold, or neutral condition. It's just momentum turning up within this bullish trending condition that reflects re-acceleration of upside and a continuation of price strength. So as the green arrows show, every time momentum turns higher within this bullish trend, then we continue to see more positive themes developing and the chances of the market extending this bullish trend and this price strength. So we can surmise that within a positive trend, every time momentum turns higher, we actually see a fresh buy signal being generated and the chances of further acceleration and continuation of that bullish trend being seen. Now, if we use an indicator that we previously have looked at within these webinars, the MACD, we can actually gauge the trending condition of the market. So it's actually when we start to see the MACD being above zero and above its own moving average that we can say that we're in an aggressive uptrending condition. Now, we know the problem with the MACD, because it's moving average based, it can be quite slow in generating fresh signals. So this is where momentum is most used within this type of trending setup. So every time momentum turns down, highlighted by the red arrows here, we look to the MACD. And if that's still above zero and above its moving average, we know that we're in an aggressive uptrending condition. So we know that we can ignore these overbought readings, and that the risk is that this aggressive bullish trend can continue even though the slow stochastic is at overbought conditions. So it's not when momentum turns down within an aggressive uptrend, it's when the momentum turns higher to suggest that the reacceleration of this bullish trend is likely to be seen. So again, every time momentum turns up, no matter whether it's overbought, oversold, or neutral, we look to the MACD. And if that's above zero and above its moving average, then again, this momentum turn higher highlights the reacceleration of the bullish trend and the potential of further development of this trending condition. So in other words, we're using the MACD to give us the directional risk, but because it's slow in actually generating new signals, we're using the slow stochastic from a timing perspective. Every time momentum turns up within an aggressive uptrend, then it's a positive signal. It's a reacceleration of that uptrend. Every time momentum turns down within an aggressive downtrend, so the MACD is below zero and below its moving average, then that's a reacceleration of those bearish themes. So we use the MACD for directional risk and the slow stochastic from a timing aspect to see when we can accelerate and continue this ongoing trending condition. So just to summarize the pros and cons, if you like, of the slow stochastic, it's great for timing trade entries, but you need to be aware of the confirmed trend. Momentum turning up within a bullish trend is a positive signal and a reacceleration of that bullish trend. It's excellent on its own for highlighting overbought and oversold readings within a sideways trading range. So it allows us to trade the range. Momentum turning down when you're in a sideways range gives us a signal that the upper limits is holding and the risk is for a resumption of downside, and vice versa when momentum turns up within a sideways range. However, because we need to know the trending condition of the market, overbought and oversold readings mean very little in aggressive trends. So we need to be aware of the trending condition with the MACD, and then using slow stochastic to give us the timing signals to enter trades and even increase risk within that developing trend as these signals are consistently seen.